needed attention or needed some more guidance from the IRS, and so the IRS came up and released the 2000 the final regulations released in December of 2019. These are now published in the Federal Register as of January 13, 2020, and these become effective as of 60 days after their publication in the Federal Register. So their effective date is March 13th, 2020. Now, basically, what the program is, let me, I just want to, yes. So the tax incentives included in this Qualified Opportunity Zone program are threefold. First is the tax deferral for eligible capital gains, whereby the taxpayer, whoever has eligible capital gains, may defer that capital gain up until the earlier of 12/31/2026, or when the investment in the Qualified Opportunity Fund is sold, or until an inclusion event, whichever is earlier. And for this deferral to be for this deferral of eligible gain, the such gain has to be invested in a Qualified Opportunity Fund within 180 days of the sale of the asset. Now, it's important to note that gain from sale or exchange of assets between related parties, as provided in the regulations, does not qualify. So this is important to note. Investments in qualified opportunity funds must be an equity interest, cannot be a loan or a debt instrument. That is another important thing to be noted by investors. It cannot be a loan or just a borrowing by a fund. It has to be an equity interest. And
Shashi,
yes.
in the interest of time, let's do this, because I know there is a lot to cover in the regulation. So if I may request you one thing, let's skip the step up in basis, except one comment that I have on this slide. The 15% is not valid anymore. Am I correct?
I'm sorry, can you repeat the question again, Rakesh?
The 15% is not valid because if somebody invests today, they only have 6 years, not 7 years.
That's correct. That's correct. Yes, that's correct. It's not valid today. But if somebody had invested or had gains in 2019, they still have 180 days, depending on when the 180-day period starts for them. So yes, the last window for the 7-year deferral or the 15% basis step up ends with 2019 gains. So that was the second benefit under the program, that you would get a step up in basis. It was 10% if the investor holds the qualifying investment in the fund for at least 5 years, and it would be up to 15%, a total of 15% if the qualified investment in the fund was held for 7 years, for at least 7 years. And the next benefit under the program was a permanent exclusion, which is the most significant and the most the benefit that most people are interested in, which is permanent exclusion, and the capital gain on sale or exchange of the investment itself, the qualified opportunity fund investment itself. If it is held for at least 10 years, then gain arising on disposition of such investment would be permanently excluded. Now, we just mentioned a couple of minutes ago that the final regulations just came about, were released in December of 2019, published in the Federal Register January 13th of 2020, and they become effective March 13th of 2020. Now, it's important or interesting to note that for calendar year taxpayers, these regulations will become effective for tax year starting after 1/1/2021. So during the interim period from the time when from the time when the Qualified Opportunity Zone program became effective up until the date when the final regulations become effective, the investors or taxpayers have two choices, two options. The first one is they can either rely on the final regulations, but if they choose to do so, they have to rely on them in their entirety and in a consistent manner for all such taxable years. Or if certain provisions of the proposed regulations work out better for them, they could rely on the two sets of proposed regulations. But again, in that case, they would have to rely on those two regulations, or those two proposed regulations in a consistent manner and in their entirety. So those are the two options or choices that are available to investors.
Okay. I guess somebody need to really consult an expert to make sure that they follow the best practice here.
Yes. All right, so now we go on and discuss some more about who are the eligible taxpayers. Eligible taxpayers who can invest or defer their eligible gains are, it would include individuals, C corporations, including regulated investment companies, RICs, or REITs, the real estate investment trusts, partnerships, of course, S corporations, trusts, and estates. So these are the taxpayers that would be eligible to defer their eligible gains. One important thing to note about here is that if you have non-US investors but who have capital gain which are effectively connected with the US trade or business, they would generally be eligible to defer such gain and invest in QF. But if any such gain is exempt from federal income tax under any treaty agreements between countries, then they would not be eligible to invest such exempt gain, unless the non-US investors irrevocably waive any treaty benefits. And in order to do so, in order to waive those treaty benefits, they would be able to use applicable forms and or attach statements to their tax return. Now the forms will be prescribed by the IRS shortly, but if say a particular form is not available, then they could attach a statement to their tax returns.
Shashi, one question. I am a US investor and I have gained from a sale of a business in the UK on which I'm going to pay tax in US. Will I be able to invest that money in an opportunity zone?
Well, it appears that eligible gain, that brings me to my next slide, which says that eligible gain is any gain that is treated as capital gain for the purpose of federal income tax, and it is recognized as and it is recognized on the federal income tax return. If such gain is generated prior to 1/1/2027, then such gain would be eligible. Now, if the gain that you just mentioned about is subject to U.S. taxation, then it appears that such gain would be eligible. Important to note, it should not arise from any related party transactions.
Great, thank you.
Certain other considerations to note also in this case are that if any gain is recharacterized or redetermined, such as a depreciation recapture and recaptured as ordinary income, then such gain will not be eligible for any deferral under Section 1400Z2 and would not get any QOZ benefits. Let's talk about step transactions. So now the final regulations have included certain clarifications, certain modifications. Some of them are very significant, and we have tried to include include and highlight those that are significant for investors. The first one that we would like to talk about is the step transaction. What basically it means is that if a taxpayer has gain from, say, sale or exchange of property, and say if a taxpayer sells property to an unrelated QOF or an unrelated QOZB, and there is gain generated from such transaction, such gain will not be allowed to be deferred if the taxpayer then reinvests the same proceeds back into the QOF or the QOZB. And this holds true even if say an investor or taxpayer sells property to a QOZB and then reinvests the money or the same funds into a QOF, which actually owns that QOZB, because in turn, as a part of an overall plan, the same money or the same funds are supposed to be invested back into the QOZB. So basically, it's like a step transaction and circular cash flow, whereby the cash that started in the hands of the entity, which was the QOF or the QOZB, ends back after the sale transaction. It ends back into the hands of the same entity. and such transaction would be disregarded and will not be treated as sale or exchange, but it will be treated as a capital contribution for acquiring ownership interest, basically. So it's important to note that, in case of such transactions, any property that was acquired as a part of this sale by a QOF or QOZB will also not qualify for the QOZBP, which is a Qualified Opportunity Zone Business Property requirement.
Interesting, and I think this is something new that I don't think this was ever discussed before.
That's correct. There was a lot of new guidance and also some modifications, some very important modifications that everybody needs to take note of. This is another area, installment sales, and well, there was also a lot of flexibility added into the final regulations for starting the 180-day investment period for investors. And this was after receiving a lot of comment letters from investors. The IRS actually adopted some of them and declined some of them, some of the suggestions. But this was one of them that was adopted. And the one that I'm talking about is installment sales and 180-day rule. So basically, when you have an installment sale, the gain from such sale is not recognized in the taxable income for the year of sale, but usually it is reported as a gain from it is reported as a gain in the year when the payments are actually received. That's the general basic rule of an installment sale. What the final regulations did was they added flexibility and it allows the taxpayers to elect to start their 180-day period either on the date each payment under the installment sale is received for that taxable year or on the last day of the taxpayer's taxable year in which the gain would have been recognized under the installment method for a series of payments received. So what will happen is either the investor could start the 180-day investment period from the day each payment was received, or could wait at the end of until the end of the year in which such gain would be recognized and elect to begin the 180-day period from the end of the tax year. Now, this could generate multiple 180-day periods. It's important to note. And the other important thing is a lot of commentators had asked, there was a lot of questions whether any pre-2018 installment sales would qualify. And the good news good news to that is that IRS has answered that question, and they have affirmed that any gain from a pre-2018 sale would also qualify, subject to the rules that are applicable to any general installment sale.
Right. I think, Shashi, this is very sort of commonsensical because I have a person who wanted to invest in opportunity zone. He was getting $20,000 a month for 24 months. And he said that, how do I keep track of 180 days? And it was too confusing for him and the amount wasn't big enough. So I think this will help people like that. Am I correct?
Absolutely. Absolutely. They have a lot of flexibility now, and just the fact that if someone had a transaction, an installment sale transaction prior to 2018, they should not feel that they missed the boat or they missed the the opportunity to have to derive the benefits of this program. So that's an important, yes, that was an important clarification.
Great. Thanks for clarifying. Thank you.
Mm-hmm. Now, this is another significant area where a lot of modifications were done. Section 1231 gain. Now, this is very important to note because when you have depreciable or non-depreciable property, tangible property basically, which is used in the trade or business, which is held for more than a year, when the taxpayer disposes of such 1231 assets, a netting process is basically required, whereby any gain after netting all the capital gains, after netting all the 1231 gains versus all the 1231 losses, if the net remaining 1231 gain, the net result of netting all the 1231 transactions is a gain, it would be taxed as a capital gain. And if the net result after netting all the gains losses in the year for such 1231 assets was a loss, it would be deducted as an ordinary loss. And because of this netting process, the proposed regulations had adopted a netting approach whereby taxpayers that would have 1231 gains would have to wait until the end of the year when they would know and they would have a when they would know how much of the gain at the end of the year was actually a gain versus a loss, and that could only be determined at the end of the year. So that was a special rule in case of 1231 gain only, that they had to wait until the end of the year. Besides that, the 180-day period for such 1231 net capital gain was to begin at the end of the taxable year. What changed with the final regulations is that the final regulations now make it more flexible, and they have now actually modified to the gross approach, whereby taxpayers would be allowed to invest the full amount of eligible 1231 gains without regard to any 1231 losses. So if you had, say, if a taxpayer had $500,000 of 1231 gain up until, say, May of 2019, and had another transaction in which they had a 1231 loss of, say, 100,000 in August or September. What under the proposed regulations they were required to do was that they would have to wait until the end of the year, and they would be only eligible to invest the net gain, which was 400,000. That has completely changed now. The taxpayer no longer have to wait till the end of the year. The taxpayer would be allowed to invest the full amount of $500,000 gain that they had in May at that time, and the 180-day period for such investment begins on the date of the sale or exchange. So this is pretty significant, I think. And this is one area where people will have to also consider whether they want to rely on the proposed regulations versus the final regulations, because of if they choose to do one versus the other, they have to rely on it in their entirety and consistently for
Right,
such
right,
taxable years. Yes.
right. Okay, no, that's a great explanation, Shashi. Thank you.
hmm Further, the other important thing to note with the 1231 gains also is that when ultimately the 1231 gain is recognized on the final end of the deferral period, which is 2026 or earlier, upon the inclusion event, Section 1231C will only recapture the net 1231 gain in the year of inclusion by taking into account only the 1231 non-recaptured 1231 losses from the most recent 5 years. There is a rule that in case of 1231 gain, if the entity had 1231 losses in the previous 5 years, those would have to be recaptured as ordinary income. But with this, it it seems like actually it appears that the 1231C recapture will be only taken into account the most recent 5 taxable years. And if you think about it, if the tax is deferred, if the gain is deferred until 2026, that 5 year period will be out of the recapture 5 year period, basically. So this seems like a favorable thing for investors.
Right,
The
but
other
it also does is that increases the work on the accountant and the client part to make sure they run multiple scenarios to see which would be the best option for them.
Absolutely. And the other thing is that it also will increase reporting requirements. I think it's important to note that the accountants and the tax preparers will have to provide more full disclosures to their investors to make certain that they are able to utilize and take benefit of all the various flexibilities and the options that are available in the program. And if investors feel that they did not have enough information, they should absolutely reach out to their tax preparers and and try and obtain as much information as possible early enough and not wait till the end of the year. That's important.
Okay, that's great. Let's move on to some
Sure.
other benefits and things of that nature so that we can
Yes.
continue the momentum. This is all great information, Shashi. Thank you.
Yes. Thank you. I also wanted to, there's a couple of more items to cover in regarding the 180-day rule periods, and that is with the RIC and REIT capital gain dividends. Generally, the 180-day period for such cap gain dividends begins at the close of the shareholder's taxable year in the year that the gain would be recognized. But the final regulations now provide that shareholders have the ability to elect to begin that 180-day period again from the date the cap gain dividend was paid, and they do not have to wait until the end of the taxable year. So that's another favorable flexibility allowed. Uh, Another date to note is that if there's any undistributed capital gains, the shareholders can elect to begin that 180-day period either on the last day of their own taxable year or the last day of the taxable year of that RIC or REIT. This is yes. Now for pass-through entities, owners of pass-through entities.
Sashi, real quick, we just wanted to ask that first poll question after that slide that you wanted to ask. So I'm going to launch that first poll question here for our attendees.
Sure.
All right, folks. So the first poll reads, final regulations allow taxpayers to invest the full amount of each eligible Section 1231 gain in a qualified opportunity fund. Is that true or is that false? And we will tabulate the responses here. And just a reminder to everybody that answering the poll questions is required for CPE credit. All right, and we are getting up there in the number of people who voted. All right, we'll just give it another 5 seconds here. Going once, going twice, and we'll close that. Now, Sashi, is that true or is that false?
Oh, the answer for the first question?
Yes.
Yes. Okay, the answer is true.
All right, and 90% of people said true as well. So everybody seems to be on the same page with that.
That's great. Perfect. So the poll closed now that I can move on?
Yes, you may.
Okay, thank you. So there was another 180-day period that I wanted to talk about was for the owners of pass-through entities such as S corporation, partnerships, and trust, non-grantor trusts. So basically, what the proposed regulations had included in their provisions was that if any of the other pass-through entities like partnerships, S corporations, or trusts, it's important to note the differential here for trusts is the non-grantor trust. If any of these entities had any eligible gain which they chose not to defer at the entity level, but they chose to allocate such gain to their owners, then as per the proposed regulations, the 180-day period for such owners generally would begin on the last day of the pass-through entity's taxable year, or the owners could elect to treat their own 180-day period regarding their distributive share as being on the same date as the pass-through entity. Meaning, if the entity had a gain, eligible gain, and the entities decided not to defer that gain or not to make the QF investment and decided to allocate such gain to their owners, the owners had two options. Either they could begin their 180-day period for investment as of the last day of the pass-through entity, or they could elect to to begin the 180-day period from the date of sale, which would have been the case if the pass-through entity had decided to invest at the entity level. Now, what the final regulations did was they kept these two options. So these two options are still available, but they added another option, which is great, I think. And this was, I believe, at the request of the NYCPA, that partners and shareholders of S corporations and beneficiaries of non-grantor trusts may elect to treat their 180-day period to begin on the due date of the pass-through entity's tax return, not including any extensions. So what it means that in case of partnerships and S corporations, the due date of such tax returns for such entities would be March 15th, and
Right.
now the partners and shareholders and trust beneficiaries have the option to begin their 180-day period as of March 15 and not December. So this gives them additional time to make the investment, which is, I believe, a very favorable and a very good revision incorporated in the final regulations.
Right. So they get extra 75 days. So instead of June 28th or so, they will probably get some time into September, middle of September, to make that investment.
Yep. Yep. All right. Moving on to I would say the next segment of the presentation, we wanted to also talk about and give some background on the requirements of the qualified opportunity funds, the qualified opportunity zone properties, and qualified opportunity zone businesses and such. So when we talk about a qualified opportunity fund, it is an entity, it's an investment vehicle for investing the gains that have been deferred by investors. Such entity, such qualified opportunity fund entity may be formed as a partnership or a corporation, and the purpose of this should be investing in the qualified opportunity zone properties. Such entity or such fund can be a newly formed entity or a pre-existing entity. But it's important to note that in case of pre-existing entities, it may be a little difficult for them to qualify because of existing tangible property, which probably was acquired prior to 12/31/17, and there would be an additional substantial improvement requirement, which we will talk in our next few slides. So, but when we are talking about qualified opportunity funds, the requirement for the fund is that it must hold average of 90% of its assets in qualified opportunity zone property, which is measured semi-annually, and the valuation is based on the applicable financial statements. The fund cannot invest in another QF. It cannot invest in another qualified opportunity fund. The fund must self-certify as a qualified opportunity fund by filing Form 8996 with their tax return for each tax year. Now, qualified opportunity funds can also be structured as multi-asset funds owning multiple QOZBs. That's important note. And what constitutes a qualified opportunity zone property? So a fund needs to invest in three types of properties, which must qualify as a qualified opportunity zone property. And what are these three types of properties? It could either be a qualified opportunity zone stock, which is acquired in exchange for cash. After 12/31/17, if an entity that was classified as a corporation was already a QOZB at the time of issuing such stock. Next, it could be a qualified opportunity zone partnership interest. Again, same requirements, acquired in exchange for cash and acquired after 12/31/17. If the entity was classified as a partnership and was a QOZB at the time of issuing such partnership interest. The third qualified property would be qualified opportunity zone business property, or the QOZBP. We will talk about those requirements in the next few slides. But the fund needs to invest in these three types of properties in order to qualify as a qualified opportunity fund, and 90% of such assets should be invested in these in order to qualify as the fund. Now we will talk about the qualified opportunity zone business property. Now, this was one of the types of investments that a fund can hold. Either it can invest in qualified opportunity zone business property by itself, or it could invest through another entity, which would be a qualified opportunity zone business, which would be holding such qualified opportunity zone business property in a two-tiered structure. Now, what is qualified opportunity zone business property? It's tangible property which would be used in the trade or business of the QOF or the QOZB, and such property would have to be acquired by purchase from an unrelated party after December 31st, 2017. Those are the requirements. The other requirements is that the original use of such property in the QOZ, meaning the original use of such property in the zone, must commence with the QOF or the QOZB, or if the original use does not begin in the QOZ with the fund, then the QOZ or then the QOF or the QOZB must substantially improve that property in order for the property to qualify as a QOZBP. The other requirement is during at least 90% of the QOFs or the QOZB's holding period for such property, at least 70% of the use of such property should be in the zone. And the 90% and the 70% clarification was provided in the second set of proposed regulations. When the first set of proposed regulations came out, they only mentioned that substantially all of the QOF's holding period and substantially all of the QOF's or the QOZB's use of such property was supposed to be in the QOZ. And investors were and the professional community were confused as to what would qualify or constitute as substantially all. So the second set of regulations clarified this substantially all standard. Now, QOZBP can be used property as long as it was not previously used within the zone for the purposes of depreciation. That's an important thing to note when a QOZB acquires property and wants to make sure that such property is qualifying as a qualified opportunity zone business property. They have to make sure that all these requirements are met. The other important thing to note is land is treated as QOZBP only if it is used in the trade or business of the fund or the trade or business of the QOZB as per section 162, and it is not held for investment purposes. So it's important to note that distinction. If land is acquired, then it must be used in a qualified trade or business. And when we say that the original use of such property commences in the zone, either with the QOF or the QOZB, what it means that the original use would commence that the property would be placed into service for the purpose of depreciation in the zone for the first time. Now, if it was placed into service already by another person or another prior person prior to such property being acquired by the fund or the QOZB, then such property would not qualify. And in that case, what would have to be done would be that the fund or the QOZB would have to substantially improve it. And we will talk about the substantial improvement requirements also in the next couple of slides. Now, what is a qualified opportunity zone business? Now, we talked about a QOF investing in qualified property either by itself or through another entity which qualifies as a qualified opportunity zone business. Now, what are the requirements of such business? Basically, such business would have to acquire qualified opportunity zone business property by purchase from unrelated parties. The original use of such property would have to start in the zone with the business, with the QOZB, or if the original use did not start with the QOZB, as mentioned by me previously, it would have to be substantially improved by the business. During at least 90% of the holding period, again, the requirements are similar. During 90% of the holding at least 90% of the holding period, and at least 70% of the use of such property was in the zone, if it was acquired by the QOZB. Another important requirement for a QOZB to qualify is that it should derive at least 50% of its gross income from an active conduct of trade or business in the zone. Now, the second set of proposed regulations had provided certain criteria for calculating or for determining how the 50% gross income would be determined, and there was 4 tests basically. There was an hours test. There was a gross amount test. There was a management and tangible property in the zone test, and then there was the 4th one, which was a facts and circumstances test, and either one would have to be met in order to determine the 50% gross income. All right. There was also another there's also other requirements, and the other requirements which deal with intangible property are that at least 40% of the intangible property must be used in the active conduct of trade or business in the zone, if at all the qualified opportunity zone business holds intangible property. In case the qualified opportunity zone business holds non-qualified financial property, such property must be less than 5% of the average and aggregate unadjusted basis. So it needs to hold tangible property, and the required standard is 70% of the tangible of the assets of the QOZB must be intangible property owned or leased by the trade or business, which is conducted by such business in the qualified opportunity zone. It's not, it would not qualify if it had more than like 5% of non-qualified financial property. So it's important that such businesses don't invest in financial property. The idea or the intention of the program is to create more jobs and, uplift these communities by investing in tangible property and creating more jobs in these areas.
Right, Shashi, I think what you just stated is very important, that it's not just to create wealth for people who are investing, but also to uplift the communities that are left behind or that they have not gotten the benefit. Now, let me move forward a little bit and talk about the substantial improvement and the original use. Can you summarize that for us quickly so we can go through the rest of the slide, because you have a lot of good material and I want to make sure that we don't leave anything behind.
Yes, absolutely. So like I said earlier, original use requirement, what it says is that the original use must commence with the QOF or the QOZB in the fund. And what do you mean by commence? The original use to commence means when it is first placed in service for the purposes of depreciation. So if it was already in service in the zone prior to such property being acquired by the fund or the QOZB, then what would happen is it would not meet the original use test, but then it would have to rely on the substantial improvement test. Now, what the substantial improvement test says that if any tangible property that is acquired by the fund or the QOZB would be treated as substantially improved if during a 30-month period beginning after the date of acquisition, such property was improved and the fund or the QOZB made an additional investment in improving such property of at least the amount of its original basis, meaning the fund or the QOZB had to make double its investment in the property for it to be treated as substantially improved. And for that, the fund or the business would have 30-month period to complete their improvement process. Now, important note in this is that land on which the building or the structure is situated is excluded from such substantial improvement requirement. In other words, say if a QOF or QZB acquires a property for say 3 million, and they allocate 10% to land, so $300,000 are allocated to land, and 2.7 million are allocated to building or the structure. In order to meet with the substantial improvement, the fund or the QOZB would have to double its investment or in other words, substantially improve to the extent of 2.7 million. So in other words, land is not required to be substantially improved. In this case, I hope I made that clear. If any questions, please definitely do ask, because this is an important thing to remember, that you have to allocate land out of property, and you're only required to make substantial improvement to the extent of the amount allocated or the basis allocated to the structure or the building.
No, I think, Shashi, you made it very clear. Thank you.
Okay, very good. So, further, with certain other clarifications and modifications relating to the original use test. So there were certain criteria relating to vacant property that were included in the proposed regulations. And what the proposed regulations said that if there was a building or a structure that had been vacant for at least 5 years prior to being purchased, are acquired by a QF or QOZB, it would satisfy the original use requirement. So the vacancy period, in case the vacancy period was 5 years with the proposed regulations. What the final regulations did was they reduced this vacancy period to 3 years. So now instead of being vacant for 5 years, the property just needs to be vacant for 3 years, and it would meet the requirement for original use. Now there is another favorable or additional special 1 year vacancy requirement, which says that if the property was vacant prior to such location being designated as a QOZ location, if it was already vacant prior to that or on the date of the QOZ designation, then the vacancy period would reduce to 1 year. So these are all very favorable changes coming from the final regulations. And the final regulations further clarified that for a real property and the structure, the land and buildings would be considered as vacant or would be considered as being in the state of vacancy if at least, if more than 80% of such building, the square measured by square footage, was not being used, and such 80% of the square footage would have to be usable space of such property. So if more than 80% of usable space uh, was not being used, then such structure would be considered as vacant or significantly unused, as uh, as provided in the final regulations. The other clarification was that investors were concerned whether self-constructed property would meet the requirements, because one of the requirements of the QOZB P was that the property had to be purchased uh, by cash after 12/31/17, and investors had questions whether self-constructed property would qualify. And the final regulations have said that self-constructed property, which is used in the trade or business of the QOZ, in the QOZ by the QF or the QOZ, will qualify and will satisfy the purchase requirement. Another important thing to note is that with the original use test, like I mentioned earlier, if it was already in service in the zone, even for depreciation purposes, meaning it was depreciated by another user before or prior to it being acquired by a fund or a business or QOZB, it would not satisfy the original use test. But what the final regulations clarify, that if a newly constructed building or a near complete project which have not yet been placed into service for depreciation purposes are acquired uh, after 12/31/17, then such newly constructed property would qualify and would satisfy the original use test if it was in the zone, of course. With the substantial improvements test, the final regulations clarify, and these are all, like, I believe these are all very favorable clarifications by the IRS, and it will definitely help the investor community to feel more confident if they're already thinking about investing in real estate projects. And what final regulations also clarify is that property will be treated as QOZBP during the 30-month substantial improvement period, and assets that are purchased. Oh yes, this is important. This is an important one, and they have provided a good example in the final regulations as well. What it says is that if the properties or the assets that are purchased by QOZB to satisfy the original use test, such assets would also count towards the substantial improvements test if such assets are used in the same trade or business as the property that is being improved, and which also improve the overall functionality of such property. And there's a very good example in the final regulations. They talk about a hotel property where a hotel property is purchased, purchase price is allocated to land, the building, and the other equipment and furnitures and fixtures, etc. And what they say is that if the QOF, the QOZB that acquired such hotel property, put additional money into the project and acquired or purchased more furnitures and fixtures. They renovated, say, there was a restaurant attached to the hotel. They renovated that restaurant by adding more equipment, more furnitures, fixtures. Then all such property would also count towards substantial improvement because because such assets not only improve the overall functionality of the property, being the hotel itself, it would also it should also be used in the same trade of business as a property. So all in all, it is as an overall investment plan. If certain amount of capital is allocated towards buying furnitures fixtures, that would qualify towards substantial improvement
So,
testing.
Shashi,
That's important.
what we have heard throughout the last 2 years is that all these interim regulations, the final regulation will come out and they'll be much better than what these interim regulations were. So it's proving to be true, number one. And number two, they're being very business friendly in the sense that they're not asking you to just do construction and double the structure, but they're also saying that if you put beds, if you put equipments and other kind of interior decoration that will help us run the business properly, that will also be counted. That I think is very positive.
Absolutely. So not only just the structural improvements, but anything else that, even if it's non-structural, but it improves the overall, functionality of such property, then yes, it will be considered a substantial improvement. And I think it's very, very, very investor friendly in that regard. All right. So moving on to the next one, they also provided for the final regulations also provided for an aggregation of property. So what the proposed regulations had said that for substantial improvement of tangible property, they would consider that on an asset by asset basis. But at the same time, they had requested comments from investors, taxpayers, as to what would be a better criteria for substantial improvement, whether any aggregation standard would be better or should be used. And as a response to the various comments received, the final regulations now said that buildings that are located on a single parcel and that are transferred in a single deed will of course qualify to be substantially improved on an aggregate basis, but also if there are buildings on a contiguous parcels but not on a single deed would also be permitted to be aggregated for the substantial improvement test if these properties were being operated exclusively by the fund, by the QOF or the QOZB, and that these properties were sharing, or these QOZBs were sharing facilities and significant business elements like accounting, marketing, etc., legal, etc., and they were operated in coordination and with reliance upon each other for the overall trade or business of the QOZB. All right. So the proposed regulations had the working capital safe harbor for deployment of capital by QOZB, or the Qualified Opportunity Zone businesses, and that working capital safe harbor period was 31-month period. The final regulations have created another additional 60 have created uh, a 62-month working capital safe harbor for startup businesses, meaning they get a 31-month period plus an additional another 31-month period of working capital safe harbor. But this is applicable only for startup businesses, and what the regulations clarify is that during such 62-month period, tangible property that is purchased, leased, or improved by the QOZB, and with cash that is deployed from a written working capital plan would count towards the 70% asset test, and also if any intangible property was purchased or licensed likewise by use of funds from a written working capital safe harbor plan would also count towards the 40% intangible property use test. So it is good because for startup companies they need more time to acquire assets, set up their business, and this comes as a very welcome change or welcome modification in the
I
final
think Shashi
regulations
is
for
very,
startup.
very business. I think you're right. This is very business friendly. And I think we have another time. This is the time now for another poll question. So Tom, please go ahead.
Yes.
Sure, thanks. And Sash, we have just about 5 minutes left here in the presentation, so I'm going to do the two final poll questions back to back here, just as they're required for CPE. So we'll get those launched now. So, folks, our our third of our four poll questions today is coming up on your screen right now. It is that pre-existing entity cannot qualify as a QOF or a QOZB. Is that true or false? So we will get all of the responses for this. Should be, give it another 10 seconds here while everyone votes. And just a reminder, folks, these polling questions are required for CPE. All right. All right, going once, going twice, and we will close that. All right. And we'll share those results really quickly. So it says 73% believe it is false and 27% believe it to be true. Is that true or false, Sashi?
The answer is false.
Oh,
the answer
very
is
good.
false. Yes.
All right.
Pre-existing entities do qualify, and of course, if they meet the substantial improvement requirements. Now that we have only a little time left for the presentation, I would like to go over a few important points quickly. I just want to skim through quickly because these are important, and I think at least we should make our attendees and participants aware of these changes and modifications. So here goes. The working capital safe harbor is increased to 62-month period for startups, and say if a fund is in an area or a locality where there's a federally declared disaster, they get an additional 24 months. So that's important to note. Talk about leases quickly. Basically, leased property will also qualify as QOZB if the lease is entered after December 31st, 2017, and the terms of the lease are arm's length and market pricing. And again, substantially all of the use of the leased tangible property is in the zone, which is important. Yeah. Again, the similar requirements, original use, substantial improvements. Leases are not subject to original use and substantial improvement requirements, which is important to note. And any improvements, lease improvements that are done by the lessee will count towards QOZBP. Important thing to note from here regarding leases is that the important thing to note is that related party leases are allowed or permitted, subject to certain additional requirements. So it's not necessary that they have to be that a lease has to be entered into with an unrelated party. Only related party leases will also qualify. However, there's a warning in the regulations, and that if the lease was entered into with the plan or intent of that property being acquired by the QF later on, and at a price which is different than the market value, then such a transaction or such lease will not qualify as QOZBP at any time, and it may be recharacterized by the IRS. This is a part of their anti-abuse rules, just as a measure that people do not abuse certain rules. Also, final regulations say that the additional requirements for final regulations is that in case of related party leases, they cannot make prepayments more than 12 months. And if there is personal property, not real property, but personal property acquired by lease, then it has to meet the original use requirement or the 30-month substantial improvement requirement, and they could purchase any other tangible property of equal value to qualify for the property to qualify as a QOZB. The final regulations also talked about triple net leases, and they gave two examples.
I'm going to have to ask Tom to throw in the final poll question, which is the requirement. So Tom, please go ahead and say this is the last question.
Sure thing. We're going to launch that poll question right now. So QOF or QOZB must complete substantial improvement of property within 1 year of purchase. Is that true or is that false? So we're going to get these answers going right here. Alrighty, and then folks, we just have a couple more slides that Sashi needs to go over quickly before the presentation completes. So we'll get those going right after this polling question. All right, We have about everyone voted, so going once, going twice. All right, and we'll close that poll question and share those results quickly. So 43% said true and 57% said false. So Sashi, what is the answer there?
Well, the answer is false because you have 30 months for substantial improvement of property, and it doesn't have to be completed within a year. So it's a 30-month period is the answer. All right, so we'll quickly talk about triple net leases. If it's a pure triple net lease, then it would not meet the trader business standard, and it will not qualify as a QOZB. It's important to note. And if it was, say, a mixed-use building, then it may where one floor was leased under a triple net lease, but the other two floors were not, and the company had operating offices which were taking care of all these leases, then such a mixed use business would qualify as a trader business under 162. Just wanted to mention that out there. We'll quickly talk about partial disposition of interest. Well, gain recognized upon disposition of the QOF interest as a result of an inclusion event is permitted to be deferred by making another qualifying investment in a QOF within 180 days. What it means is that your original investment was sold or treated as or included in your gross income due to an inclusion event, then the investor has the option to make another deferral of that gain if they invested it within the 180 days and subject to certain requirements. Let's talk about further. Yes. Now, originally, with the proposed regulations, the full disposition of the original investment was required. Final regulations say that even if such interest is disposed partially, it would still qualify. So partial disposition is qualified. Okay. I would like to talk about acquisition of QOF interest from person other than the QF. So what it means is that for an investor to obtain or to acquire QOF interest, it doesn't have to be just from a QOF entity. They could also acquire such interest from another person who had previously owned interest in such QOF, and it's not necessary that the other investor had made a deferral election for such gain. There's not a requirement, so that's good. There's not too many restrictions as far as that is concerned. Important to note a couple of things about inclusion events. Well, if any transaction has the effect of reducing or terminating a QF investor's direct or indirect investment by sale or any such type transaction, or if it has the effect of cashing out of the investment in case of like distributions in excess of basis, or even a claim of worthlessness with regard to such qualifying investment, then these will be treated as inclusion events, and at that point, the gain that was originally deferred will have to be recognized into income. Now, I have certain examples of transactions that qualify as that are treated as inclusion events, and certain that are not treated as inclusion events, and they're pretty straightforward, pretty clear. Important to note that if a QOF is decertified, that is also an inclusion event because it then ceases to exist as it ceases to have its status as a QF. Next thing I would like to talk about, yes, some examples that are there, pretty straightforward. Yes, I would like to quickly talk about the disposition of the investment after 10-year period, which is important. So what the proposed regulation said that if a taxpayer had a qualifying investment in a QF partnership or an S corporation, and they held that interest for 10 years, and then the QF partnership or QF S corp disposed such property after 10 years, the taxpayer was able to make an election to exclude such gain that was allocated to them on their K1s. And in this case, it would be some or all of capital gain could be elected to be excluded from income. If the QOF investor would sell all of his interest in the QOF partnership or S corp, then all of the gain could be excluded for income. So that's the distinction that you have to note. And what the final regulations, and this is probably the last slide, this is my last slide, what says is that the final regulations have just expanded this availability or this option for investors to exclude their gain from the sale of not only the sale by the QOF itself, but also the sale of assets by the QOZB. So it has been expanded, and the same exclusion of gain has been afforded to the QOZB as well under the final regulations, which is important. And what they say is that the gains not only apply to the 1231 gains and depreciation recapture, but also but would not apply to income generated from ordinary sale of inventory. Just a thing to be noted. And finally, the IRS wanted to have a safeguard so as not to provide duplication of benefits under the program for sale of assets by the QOZB. So what they said was that any future tax benefits attributable to the reinvestment of proceeds from sale of such assets would not be permitted. And for this purpose, the QOF would be treated as making a distribution to each electing investor of its share of proceeds from sale of such assets on the last day of the year of the taxable year, and the investor would be deemed or treated as having reinvested the same amount back into the QOF. And such investment would be treated as a non-qualifying investment, and it would not be eligible for any future QOZ benefits, and would be treated as a mixed funds investments. So I think with that we conclude our presentation today, and I hope I was able to include some important highlights and some important clarifications in the final regulation.
Very much.
Thank you.
You had a lot to cover today, and I appreciate you giving us full time. And Tom, thank you so much. You can take it away, please. And thanks everyone who participated.
Yes, absolutely. Thank you, everybody, for sticking with us. I know it was a ton of information, and Sashi did an incredible job. Thank you so much for giving us all of that great information on these final regulations that relate to opportunity zones. And thank you to Rakesh for emceeing throughout the presentation. Rakesh actually joined us from India today, so I'm sure he's looking forward to going to bed and getting some sleep. So thank you so much, Rakesh, for joining us. Folks, for more information on Accountants World, you can visit our site, accountantsworld.com. And to watch our entire Opportunity Zones series, we ran a 6-part Opportunity Zone series. You can go to the link that reads pages.accountantsworld.com/opportunity-zones-webinar-series. Thank you so much, everybody, for joining us today, and we hope to see you at other Accountants World webinars in the future. Thank you so much.
Thank you.